Hi, everybody. Welcome to the program. We're so excited that we run How to Run and Grow Your Law Firm. We've been doing this since January. It's my gift for my firm's 25th anniversary. I thought it would be a great opportunity to open everyone else up to some of the amazing resources that I've had over the years that helped me grow my practice. Today, we're very lucky to have two great speakers, Anthony Citrolo and Barry Jackson, and I'll introduce them in a moment. I hope you're going to join us next month when we have Sam Millay, and he's going to be speaking about how to delegate 95% of your tasks to a virtual assistant. But today, we're very lucky. We're going to be talking about buying and selling a practice and succession planning. And I also hope you'll join us later today at 5 o'clock when the Tax Law Committee has another speaker from Anthony's firm. Kyle Griffiths is going to be speaking about also buying and selling a business. And we have Christine Malafi, an attorney, and Ken Gashel, a CPA, who will cover these exact topics in more detail, what to look for in your agreements, the tax consequences, etc. But today we have the pleasure of Anthony Citrolo, and Anthony is the managing partner and founder of the NYBB Group and the NYBB Commercial Real Estate Group. He's a certified public accountant for over 40 years. He's a certified exit planning advisor and a certified merger and acquisition advisor, having founded his firm over 18 years ago. He's the president of the New York Association of Business Brokers, and he's on many boards, and he's been very active, and he's a co-founding member of the Business Exit and Succession Planning Committee for the New York State Society of CPAs, having chaired that committee for a while. Barry Jackson is the legal recruiter for Impact Legal Resources. He's the CEO and president of Impact Legal Resources, and he was the principal of a book for the New York State Bar Association, Best Practices in Legal Management. And he's the past president of the Association of Legal Administrators. So I don't want to take any more time away from them. I'm going to give you the code now. I'm going to give you the code later. The code for today is 968X. 968X. Take it away, guys.
Thanks, Karen, and thanks for the opportunity to present to the group. It's really it's an honor and a privilege to do that. Hopefully today our goal is to share some insight as it relates to exit and succession planning. I believe a lot of the same concepts apply to law firms as they do to general firms out there, whether they be professional firms or other businesses. And Barry's joining me. Barry's been on the inside, kind of looking out of what happens in law firms. He has some very good kind of not just small case studies, but situations that have happened for kind of lack of planning or just things that typically happen that could really undermine the value of your firm. So I'm going to pass all of the certified stuff, but today's our topics. We're going to look at the marketplace a little. We'll look at some of the keys to success. We'll talk a little about law firm exit and succession. I have picked several transactions that have been done. You'll see what the sold amount was for those firms, and also some that are on the market without specific detail. They were pulled from various databases that we use. I think will be interesting, and we'll go from there. First thing we talk a little bit about is what actually is an exit plan, and it really is. It's a roadmap to successfully exiting your business. And we find that a lot of folks are, I talk about folks who kind of are like the shoemaker is his own worst, he has the worst shoes, right? So we talk to folks about planning their exit. We talk even from a legal standpoint about that. Okay, I'm a CPA, I let the lawyers do that. But I think a lot of folks fail to plan, and they end up in situations that I think really, really harm them, whether it be a result of illness or burnout or divorce or death. We've had situations where folks who, suddenly something happens to them and they have no exit plan. So their $2 million business or practice all of a sudden becomes, really, really left kind of to no one for the most part. And as you and I both know, all you need to do is have a short period of time where nothing good is happening, where there's no communication, and people do find a way to go somewhere else. Now, Barry, we've spoken a few different occasions. I know you've seen some instances where there were some situations that happened, especially in law firms. Maybe you can kind of share that information with us.
Sure. I've got over 30 years of experience with law firms, mostly as an executive director. And I was literally at two of those law firms when the managing partner suddenly and unexpectedly died. And one of them in particular, it was about a 50 attorney law firm in New Jersey. They weren't ready for it. A month before the managing partner died, and nobody even knew he was sick a month before. This all happened within 2 weeks. A month before, they decided to look into a succession plan. But that's no way is that enough time to get your act together before the firm's going to fold, or firm could fold. And they just weren't ready for it. And I could sit here for the entire hour and tell you all of the stories, but I will tell you one of the things that happened was the management committee, which consisted, I don't know, 7 people or so. Say 3 of them brought in all the money and 4 of them brought no money in to the firm. That caused friction from the get-go. And the managing partner that died was the glue that held the firm together. So without him, it was absolute chaos. And I actually witnessed an armed guard at the door protecting client files because people were coming in and raiding the firm. I've seen everything. And then on the other side of the coin, I was with a 110 attorney law firm in Manhattan, and they planned properly for a succession plan. They had a management committee of about 5 people. They expanded it to 9, and everybody on the management committee was over 60. They put 4 new people on it in their 40s. And the whole point was to transition these people so that they could run the firm if anything happened. And sure enough, two or so years after they set this up, the firm, the managing partner died unexpectedly of lymphoma. And I hate to say unexpectedly, he had it in the 80s, he was in total remission, and it came back very suddenly. And they had a seamless transition. Everything went perfectly because it was well planned for. So those are my 2 stories. Anthony.
Great. So, so it's a good way to start the presentation with a little bit of a shocker, right? And these things do happen. We've seen it happen in all sorts of professional firms and regular firms. When you look at it, so, if I'm looking here at just general business, the Family Firm Institute did some surveys, and these numbers are really for folks who are in general business, and the numbers tend to be even smaller in law firms. Only 30% of family-owned businesses survive into the 2nd generation. We find very few law firms are going into any other generation, and only 12% survive into the 3rd. And if you think about it, in all your dealings with business owners, how many 4th generations have you ever seen? So that's as part of planning, that's not really what it is. And if you look at it, there's 10,000 folks every day who are really becoming baby boomers, turning 65. 65% of the private businesses in the US are owned by these baby boomers. And I don't know about you, but in general, business-wise, 80% plus of folks' wealth is tied up in their business. And that may be the case with you and your practice as well. And it looks like, I think the statistic for law firms is of the senior partners, 65% of them are age 60 or over. And many of them have to transition, but they haven't figured out how to do it. And that's the case in all sorts of general businesses. I know, I'll go to the next slide there, let's see. So as far as exit options, most people have no clue in terms of what their exit options are. I think it comes upon them suddenly, like what Barry was talking about. And I think we have some issues with that. What I find very interesting, and maybe you guys find it, they find 75% of the folks who who actually exit their business in general really are not satisfied with their life thereafter. So they're really not sure what they want to do with, with themselves. So, Barry, you have anything to add there?
I do. Exit options isn't just for the firm, it's also for the partners that are there. I witnessed at the New Jersey firm that one of the most senior and well-respected partners on the management committee that had zero book of business had to become an associate at another firm. And that is what happens if you don't have a succession plan, either for the firm or for individuals within the firm. So it's just, I can tell you that was shocking to everybody that worked there, because this partner was incredible. Another thing, think about out of the box things that can happen to you. For example, I worked at another firm where the sole proprietor of that firm was, and I won't mention any names, but he was suspended for 4 months from the New York bar for something that he did. That meant he had to change the name of his firm because he was the sole owner. He had 28 to 30 attorneys working for him. Everybody, he had to tell all of his clients what had happened. He had to fess up and just make it all public information. They had to send their checks to a different named firm for 4 months. And then after that was over, he changed his name again. Things can happen that you don't think about every day. And that's one of the things that we're bringing to you, just to get you to think about this stuff. Anthony?
And, yeah, okay, thank you. And I think, my point is 3 out of 4 business owners regretted the decision. Now, I don't know if you look at your firm, can you see yourself doing something else? It's really a personal decision. And
Right, so what are you suggesting, that they stay somehow involved?
Well, I think there's a few choices, Karen. It's a good question. So I think in one way, shape, or form, most transitions require you to stay involved, right? In one way, shape, or form, because a lot of times you are the rainmaker, and I guess you're a good example of that. It's going to be hard to kind of detach you from your firm. For the people who don't want to do that, though, it really takes some planning. Like, what will you do? Well, we find folks, quite frankly, who get on in years. Now, I'm not sure what that means anymore because I'm 66. So I used to say when you're north of 60 or 65, but I'm still going. And I know some of my colleagues are, but we find folks who really are 70 plus years old. They really never want to exit. They don't want to detach. Many of them, whether it be their practice or their business, they would just as soon kind of tailor the practice to their lifestyle rather than build it. So they, if there is a sudden loss of a client, it actually fits in with their planning to a certain extent. It's a little convoluted, but we see that with a lot of CPAs, especially CPAs who get older and kind of maybe don't want to perform their function 5 days a week, but want to do it 3 days. They work it so that they have 3 days worth of clients. And I think that's, it's unfortunate, but Karen, I think it really takes kind of a big picture in terms of where you're going to be, what you want to do, and how long you want to do it. And then you put a program in place. It's not an easy decision because it's what you've done. And most people have spent more time at their practice or their business than they have at their home.
Yeah, I see a lot of people wanting to work 3 days a week and not have the 5 day a week.
Yeah, and look, I think there's probably a good market for you to stay there and do that, especially with the lack of quality help that's out there, number one, and the fact that many of the principals, they are the relationship folks, and you'd hate to lose the relationship folks. A lot of them, if you tell them, hey, listen, you could just be the relationship person, you could be the rainmaker, you don't have to do any of the nitty gritty work, you don't have to do any of the analysis, just keep on, getting the name of the firm out there, getting the name of the business out there. They would be thrilled, I think, for the most part. And others would say, listen, I don't want to do anything. I want to just get the heck out. And if they are great and they want to just go play golf the rest of their life, then at least they have a plan, right? And so, but I think most people are not really like that. I fail to see a lot of folks who are absolutely thrilled, although I do have some CPA friends who exited, big 8 or big 4 CPA firms. And they were ones who were fortunate enough to have some kind of pension, and they're happy not to be there.
I also think that because of COVID, a lot of people are working remotely, and it's more acceptable now to not be in the office, as much as you once were.
That's true. I also think what's happened too is COVID has put kind of more of a time frame on people, and they're going, listen, boy, I'll tell you, if you look at I tell folks, if you look at the last 20 years in New York, right, and you survived in business. So what happened 20 years ago? We had, unfortunately, we had 9/11. Then in 2008, 9, and 10, we had the recession that seemed to last forever. Okay, then you had Hurricane Sandy. So if you were in New York, there were so many different things that you had that were really out of your control. The last thing you said, what else could there be? A pandemic? And and who would ever believe? So I think if you've really survived the last 20 years, whether you're a law firm or CPA firm, whether you're any other kind of business, and you still have some good enterprise value and some good marketability, and you have an ability to do some succession planning, it's begging you to do that. And I think you'll be in the minority, and there'll always be a place for you if you want to stay in one way, shape, or form. And so we talk a little bit about, whether it's exit planning or succession planning or estate planning, they all kind of come together to a great degree. They're a little bit different in a lot of ways, but I know, Barry, you've seen some things about firms that I guess required sabbaticals.
Yeah, they were absolutely, they had to take a sabbatical. If I recall correctly, it was every 5 years or something like that. It was just a guarantee that partner wasn't the only partner that had contact with the client, and they would have to take the entire 3-month summer off or some period of time that they all agreed upon. But it was required so that the firm could prove to the client that everybody would be fine without that partner, and the clients would then belong to the firm and not to the partner. I've also seen, speaking of planning, your succession, I've seen things like in partnership agreements where you would be required at that same firm to pay in 5% of your compensation to your capital account every year. So that 5% would build up to a considerable amount of money when you retired. And when you retired, they were required to pay you back that plus interest. And you were earning interest all along when you paid it in over a 5-year period. So it became a payout for the partners, and it made transitions much smoother. And at that firm, they required mandatory retirement. So there are things that you can think of in advance to take care of these situations, to make everything smooth.
It's interesting. So I set up a kind of a forced, like a sinking fund with a forced retirement for payment, so that at the end of the day, the person wasn't leaving with, as we would call it, a firm grasp on an empty bag, right? So we had
That's correct. They also had mandatory insurance policies. Some of the policies would be payable to the firm, some would be payable to the families. They didn't want to deal with the family struggling if one of their partners died. So they made sure that they had proper insurance. The firm would be involved in that. So yeah, there are many ways you can deal with this. Interesting.
We talk a lot about succession planning with folks, and is there a succession plan? Let's say there is. You have to look and see how you're handing off from the current management to the successor management. Does the current management, what are your objectives, timing? What are your personal ideas? And can the successor management really handle it? Can they really keep the firm running? Can they keep the business running? And you have to understand what their specific roles would be. Also, we have to determine the financial needs of the current management who are retiring, perhaps, and of course the viability of the business to support what their requirements are, because some of them still want to continue to get paid as they go forward. A lot of them don't have specific retirement plans in place, and we see that with every business in general. And that's why we say 80% of our transactions that we work on in the regular marketplace, 80% of the folks who we talk to, their retirement is directly tied into the exit of their company and the ability to sell it, in the regular marketplace. And that's a frightening number, right? Especially, you talk about COVID, nobody really expected that to really happen. And if you happen to be in a marketplace that really got hammered, like for instance, I was talking with someone last night who was in the trade show business. They produce products and goods and services for the trade show industry. Well, has not been an event that they have serviced in a year and a half, and every one of the orders that they had got canceled. So if they were anywhere near exit, the last couple of years it could have put them out of business. Of course, they're coming back now, and I guess there's nowhere really to plan for a pandemic, right? So I think, but there has to be some planning involved. A lot of people don't want to really, approach the subject. It's pretty interesting. And Barry, I know you've talked about debt and pay for your future assets with a loan.
Yeah, it's just another thing to consider, because what happens a lot in law firms is so let's say you want to buy an accounting software and it's $150,000, and you take a term loan on it and let the future partners pay that off because it's going to benefit them. But let's say a bunch of partners are going to retire this year. Why should they pay out of their compensation what's going to benefit the firm in the future? But you've got to think about stuff like that when there is an issue, because all of this stuff comes up. Another thing you need to think about is you have to keep your people from quitting. I'm not just a legal recruiter. We also have back office accounting on a project by project basis and fractional COOs. And one of our situations with another client was they were winding down. And the day they announced it to their accounting staff, every single person in the accounting staff stood up and walked out the door. So they had nobody to wind them down. So they came to us and we made that happen. But that's one of the last things I think you'd want to deal with when everything else is going wrong is for your people to leave. So you could have stay on bonuses. I've seen that in many places. And people listen to that stuff. People will stick around if there's some incentive at all for them.
Sure. So a couple of
Let me just interrupt.
Sure.
And give the code again, because I see we have a few additional attendees. The code for today is 968X. 968X. Thank you, guys. You're doing a great job.
It's a key code. So if you want credit, so I did a little statistics, little research. The people who are 60 years old in big law firms, 84% of them, 84% of the people there are partners. So you have kind of a real pyramidal kind of structure in terms of, like, there's a lot of folks in the firms who are older, and I think in general, attracting younger professionals is difficult. It looks like some of the firms have mandatory retirement, but people feel today, 65 is the new 45. Karen, to your point, they feel like they can just continue to go. A lot of
I also want to say that our audience is probably smaller firms. They're probably
Sure.
not these large firms.
Sure.
Just keep that in mind.
And I think, it's maybe even tougher for some smaller firms, right? But, the bigger firms subsidize retirement plans. And this is why I put that there. Smaller firms, of course, sometimes don't have the capability of doing that. So it depends on what kind of firm you're with. I know, Barry indicated about, the folks who put the sinking fund together with 5% so that they have some kind of retirement. You have to really, it's part of the planning process. The questions we ask people in general. So if you have a lot of solo practitioners, some of the questions don't and do apply. And we say this just in general to business owners. How many of your folks are north of 60 years old? Just in general, because, it really has a lot of impact in terms of the ability to continue your firm, number one, and continue your business, and also the transferability of it. A lot of businesses and practices in general, they want to see some pretty good talent. And if you have some decent talent, whether you're small or big, it really it's very impactful. Who do you have is going to take over the leadership role? Would if a partner, let's say you're a 2-partner firm or a 3-partner firm, even a small firm, would one of the partners leaving really have a tremendous impact on the overall business? Would clients bail out if the partner leaves? It's part of the transition. That's why oftentimes when we do transaction work, it's almost, it's not considered a takeover by someone. It's really, it's couched as a merger, but a lot of times, of course, there's a primary buyer of a business or a practice, and then there's the one who's being taken over. And then there's so much knowledge built into some of the folks who've been around for a long time. They have great institutional knowledge. They have the contacts. They have, the public social kind of media presence as well. And then, Barry had talked about what happens if they leave suddenly. Barry, we were talking about being a rainmaker and what happens there.
Well, what happened at the firm I was at when the managing partner died and they weren't prepared was, say, 3 of the management committee members brought in almost all of the revenue for the entire firm. And just so happens that a lot of people sitting on the management committee had been there for years, and, cousins or nephews, and it was a little bit inbred. And the partners that had all the money said, why should I stay here and subsidize all of these people? And it just all of a sudden just crashed, because they were out of there within a month. And that's what I witnessed. And it's all it's all avoidable if you take care of this stuff in advance and everybody agrees to it in advance. It's completely avoidable. Another thing I just wanted to interject, which is, I think, related, is you have people that are 60 and 70 in a firm, are younger people joining your firm. And that's one thing I wanted to address, is one way to attract them and to keep them is to provide, or at least encourage, having a marketing coach so that they can get a book of business, because that is valuable information. That's valuable education for people that are starting off. I've seen it. I arranged for that in firms that I've worked with. It worked miracles. I spoke to one particular associate that was just promoted to partner at a firm that I worked for. And he was complaining to me that he was taking home less money because of the tax situation. He had to basically pay for all of his taxes. None of them were subsidized by the firm anymore when he became a partner. And he was just complaining. So we had a discussion about it, and he automatically thought that the managing partner at the firm was making the most money in the firm. And I said, think about that again. Think about the person that brings in the most money to this firm. They're the ones that are making the most money. And I said, if I were you at your stage in life, even if the firm doesn't pay for it, I would go for a marketing coach. I would pay for it and get that myself. And that particular partner that I spoke to is now the managing partner of the firm with the biggest book of business in the firm. So he listened, and it was sage advice. And I think he was very happy with that.
Yeah, I think that's very good advice. So maybe you could address the situation. Take my situation. So I'm in business many years. We're very successful. We bring in a lot of business. We have a number of employees, a number of people on the legal team, some young, some middle-aged, some older. We have a lot of connections and contacts, over 17,000 names in the database. How do you transition those relationships, those circles of influence, to continue to bring in business? I'm not leaving anytime soon, but maybe it's important for me to start transitioning some of those relationships to the younger staff. And we do transactional work. We handle IRS and New York State tax problems. And so someone has a problem, we handle it, and then we move on. The circles of influence stay the same. We get referrals from the same accountants and attorneys on a regular basis, and the clients are different. So how do you take this type of firm, a small firm, and have a succession plan? What ideas do you have for someone in my position?
The entire plan, or just about keeping attorneys?
Any part of that you want to address?
Well, basically, this is almost, I don't know if Anthony agrees with me, but it's almost you got to have some type of retreat where you discuss this, specific for your firm, and you have to get the culture and all of that. But I'm thinking, in the initial part of your question, you should have younger associates communicate with your client, even if it's at a lunch or on Zoom or some other way where they're visible. If you have an attorney that works for you that has clients, you need to have dinner or lunch with that client, maybe quarterly, because the client has to know that the main partner is not the only contact, that the entire firm is working on their behalf. That's a big part of it. It has to go to the client and their perception of your firm and the staff that's there. So
right. So in my case, it's not necessarily the client, it's the accountants and attorneys that refer
Yeah.
us. And you're right, to be visible, I think, is a very good point. Take the younger staff out to different events, which we've done regularly, and we let them speak and write, and
Right.
and so everyone gets to know them as well.
I
Yeah,
think,
I mean,
Karen, go ahead. I'm
ahead.
sorry, Barry.
I've seen in a small firm where the partners were promoted by the managing partner to very much encouraged to write articles, get themselves in the paper. He would encourage that. This particular partner, I thought, was a marketing genius. He was very visible, and he had all of his partners be very visible, and it just makes a big difference.
Yeah, we encourage everyone to get out.
Sure. I think, Karen, it's interesting because, you're well known, you have a big presence out there, right? So I think it may be a little more challenging in a lot of ways because it's, no one's going to be you, but I think you have to look and say, hey, who of my talent, maybe it's multiple people, have the ability to kind of be trained and be mentored to do not everything that you do, but some of the things, and maybe they will develop their own niche, especially, given the fact that many of them are younger than both of us, right? So there could be a real opportunity there because you want to start developing relationships, maybe at a different level to a certain degree. Obviously, it's not just staff on staff. You still want people to go and consider, speaking to the partnership level folks and the people who are the decision makers. But I think you have to kind of select and say, who really would be somebody who could step in my shoes, or what 2 or 3 people could do that. This way you can kind of promote them to a certain degree and almost have them tail you and introduce them as part of your team. And then when there are, and you do this pretty well with I know some of the cases we referred to you. I mean, so all of a sudden somebody in the office becomes the go-to person. So I think inside the office, you have a great system. I think the part that's outside the office that brings in the business is somewhere where you can have to find that person or those 2 people who have the desire to do some of the things that you do to kind of generate business, and also desire, and also you have to assess whether they have the capability of doing it, right?
Right. And I guess also, look,
standpoint.
so what are the options? For a small firm, you could bring someone in from inside already. You could bring someone from the outside in.
Mm-hmm.
I could merge in with another firm. Somebody could, quote, buy my firm, I guess. I mean, those are, right? Those seem to be the options.
Look, I think you could become, in another firm, you could become a part of another firm, and, especially someone who does not offer your services. For instance, I have folks on the CPA side who, ran M&A practices, and there were a few guys who were very well known, and they were with one firm and decided, and they were with a law firm, and they decided, hey, listen, the group of us have pretty good qualifications, and we, as an entity, we can kind of bring our business almost anywhere. And they were a welcome addition to what is a pretty major firm here on Long Island, and it's been a win-win because they didn't have the capability of doing on the M&A side, and now they do. And of course, internally, the attorneys there are referring a lot of business to them. So you got to look and say, you also got to look at culturally, who you're going to be able to play in the sandbox nice with, and who's going to be really somebody that you fit in with and they fit in with you. And sometimes, it's kind of like dating, right? You got to date a lot of folks and before you're going to marry.
Right. So, and you brought up an interesting thing. So I was approached many years ago by a firm on the West Coast saying we would like a presence in New York doing what you do. So
Mhm.
there, you know, you got to think out of the box. And now certainly with the pandemic and everyone working from somewhere else, that option looks, you know, like it could work. It could
There are a lot
possibly
of people who regionally want presence. I mean, you see that in professional firms, you see that in law firms, you see that in accounting firms. They want to have a New York presence. They're scared to death to actually just go and open up an office here. But if they have somebody who has the ability to go there, maybe you go in with them as kind of a joint venture partner in one way, shape, or form in a separate entity where you're providing services. I think there's ways to do it. And then there could be an ability down the road for them to, you know, maybe take over the entire firm. They're going to want leadership though, right? So if somebody comes from the West Coast and says the East Coast and they see Karen, they go, Karen, okay, maybe we're your exit strategy, but what's the leadership look like afterwards? Because we're not coming from the West Coast to run your firm. You got to determine who those people are
and
internally.
we also see it. We also see it. It sounds crazy. So I do a lot of work on Long Island, and I know people on Long Island. I get a lot of referrals from Long Island accountants and attorneys. But people who are in New York City or New Jersey who do exactly what I do don't get those clients. And so I've been approached by them as well to say, you know, hey, how do we have a Long Island presence?
Yeah.
So like you're saying, the regional aspect of it.
Yeah, and yeah, I think, you know, it's good to pursue it, and I think the leadership part of it really is important. And I think sometimes that's, you know, and you can't expect anyone to duplicate what you do specifically, but if somebody can get close and somebody has some other capabilities, I think it's interesting. For example, in my firm, I mean, you know, I don't expect to stay forever. Okay, I don't expect to go anywhere, but I realized that, you know, I needed to get younger, so we took in two partners 3 years ago now. One is 10 years younger than me. And the other, who you mentioned, Kyle Griffith, who's really kind of made a name for himself in the industry. He's 20 years younger than me or more. I mean, I have a son almost his age, but he, you know, he's now kind of taken, those guys have taken the leadership part of the practice. They allow me to continue to do what I do best, meet people and talk with people, do some presentations, and also, you know, kind of be part of the firm. But at least, you know, they have actually taken taken the baton and run with it. And I think
love that.
It's a great way to do it if you can find it. And, you know, you got to be, first of all, I think you got to be flexible. You got to be a little bit lucky, and you have to look pretty hard. I mean, for instance, Kyle, who works with me, worked with us for 10 years.
Wow.
So we taught him the industry. He's learning well. He probably knows some of the things he knows better than I do. And he's very involved. He's the incoming president of the IBBA next year. So, I mean, he's doing things that, you know, I have done in the past. And it's just, you know, it's one person out of, you know, hundreds that we've come across, right? I'm sure you feel that way maybe about your staff, and maybe everybody on the call feels the same way. So I think it's something you have to really look at and really plan for, and realize you're going to have some frustrations. And sometimes you may feel like you're paying people, you know, too much money, but, you know, do they have what it takes to really kind of get to the next level, and do they want to? They don't necessarily always share that with you.
So again,
Anthony,
we've been focusing a lot on the younger generation coming into your firm. Speak a little bit about actually selling your firm.
Right. Okay. So I think, you know, what it really takes, selling any firm, right, or selling a law firm for the most part. So just a couple of things. One, we're not here to give legal advice, right? But I just, you know, I pulled this up, Karen, and we spoke about this, and you know, I actually researched it, and it was in part of the documents. It appears that, you know, you have to sell your entire firm if you sell it at one time, okay? And I did find out too that there only are 2 states that it looks like that permit ownership of a law firm that not by lawyers, and that is Utah and Arizona. Remember, I'm not a lawyer, so these are things that you got to kind of look at as far as options, you know. And I think these are some of the things. We're going to pass by this because we're running out of time.
Well, so you brought up Utah. Actually, that was a discussion that came up recently, and it's actually an opportunity for a lot of people. Like you're saying, non-attorneys can own the firm. That's something.
That's kind of the trend, you know. And then sometimes that works, and sometimes that's great. You know, sometimes you also end up with, you know, you end up with a little bit of micromanages in terms of what happens. Some of the problems there are they may not completely understand the industry. You got to make sure there's no independence issues in terms of who takes over. And, you know, they have maybe a different management approach than somebody who's been in the trenches, so to speak. There's a lot of benefits, though, because you do have diversity of ideas a lot of times. And, maybe have a better employee pool. They put together good incentive plans, and they really are, from a business standpoint, they manage the practice, right? And I think that's where sometimes, I'd say professionals in general have problems. I even said it about whether it's CPAs or attorneys. The business management part of the practice is not exactly, what their forte is. So, but let me talk a little about, for you, talking about valuation and that kind of thing, and Barry, you have comments there. I know we were talking about bringing in business.
I was going to talk about it later for strategic planning, but also if you make your firm more viable, you're going to be safer and safer. But for example, Karen, you're in a tax law firm. So if you could think about bringing on or joining with a firm that does T&E or that does corporate securities or whatever, somebody that would need tax assistance or they need a tax arm in that firm. Those are things that if you plan out and implement, they make you stronger and stronger, and things are less likely to go wrong later.
Except that one thing. So I'm a niche boutique. I only do one thing, and I do get referrals from T&E attorneys and corporate attorneys. So if I brought on those practices, some of those people wouldn't refer business to me anymore, because I only do exactly what I do, and I don't compete with any of them. I get a lot of business from them, and I get a lot of business from accountants who may start handling notices from the IRS or New York State on their own, and then realize they don't know what they're doing, or they don't know the rules, or they're not capable of taking it to the next level. And so again, I'm not competing with any of them. I'm only helping their clients. I'm not taking away their clients. And so, yes,
Okay.
It might be helpful to bring on additional practices, but right now I'm a boutique, I'm a niche.
Sure, but that's the whole reason of having a strategic plan retreat, to discuss the pros and cons of every move and to come up with a strategic plan. Everything you've said is completely valid. I don't know all of your situations, but that's why I mentioned it.
Yeah, I think you had great advice, which is bring in the younger people from within, teach them, give them a marketing coach, teach them how to bring in business as well. So it's not all dependent on me. Get them out there writing, speaking, introduce them, make them visible. I think those, doing it from within is great, except that they might also take that business and leave and start their own firm. But I think that's one of the great strategies.
Yeah, you always take that chance, but people tend, if you offer these things, they're not going to leave you so quickly. They're going to stay there because they're comfortable there and they're learning.
Right. Look, I think I say you really just got to go sometimes with your instincts, right? I mean, you could have anything written down, but if instinctively somebody has what it takes, I think you have to kind of roll the dice a little bit, and obviously you're not going to give away the keys to the kingdom to that person, but you're going to promote them a little and not kind of inflate their ego too much, but make them kind of the quasi superstar, right? And I think they'll bring, the first time they bring in a piece of business and they get compensated on it and they realize that they can do it, then you have somebody who can actually perform, and then you see how they can develop. That's why people love to have a succession plan with somebody in the family, because they feel like they can trust their son or their daughter or whoever it would be. But you don't see that happening too much. In the last couple of minutes, I just want to talk a little bit about valuation. Some of the things
Sure.
that we've seen. It's still kind of a young market in terms of valuating, especially law firms. So it's hard to get comps. I do have some recent transactions we're going to show you. The rules of thumb really are somewhere between 0.3 and 1 times annual revenue, but it's really, a lot of the payment is really based on realized revenue going forward. So you will find that a lot of the payment would be kind of tied in with an earnout, where you won't get a ton of money up front, but you'll get it on as clients are retained and as business progresses. They want to make sure that they're not paying you out today and then tomorrow and the next day and next year they really don't have any business. So it's going to be incumbent upon the owner to stay for a while, to make the transition work. And also, it's going to be important for you to really assess who the buyer is. Do they have the capability of running the practice? Are they really the right folks? Because if they aren't, and you're going to tie your payment into future realized revenue, you could really kind of, end up in a very bad situation. So I think, it's worked in a lot of different cases. I don't know, Barry, if you've seen any of that.
Yes and no. Yeah.
Okay. And I think also, there's got to be a strategic plan to grow the business going forward. Most of the folks who buy it, want to know what really the capability would be to grow the practice at that point. You do all the typical due diligence work that everyone does, reviewing tax returns, reviewing office leases. One of the things you want to do is you want to see whoever's going to take over your practice, what their book of business and what their profile looks like. You want to make sure they don't have any malpractice issues over the last few years, and that they are absolutely clean, because they're going to be servicing your clients down the road. And you'd be surprised sometimes what you find out. It's almost like doing a lien search on a regular business. I think it's important to do that, and make sure you find the availability of insurance so that you can actually be covered going forward, especially if they're taking over some of your cases. Right? You got to look at salaries and bonuses. If you're buying based on a future stream of income, then that's how you're going to get paid. So you got to realize it's a little bit risky at that point. Oftentimes, you may end up being the financier of the business, even if there is some kind of note. And I think the message is that you really have to make sure that you kind of protect your asset, the one that you basically have developed. One other thing I really want to just talk about, there's some transition things here that we can kind of go over, but I think when we end at 135.
Yes.
Okay. Here, it's an interesting, I pulled up some recent transactions that show, where did they go? Okay. That show that were listed on one of the sites that we work in. And, in some cases, there's more information, some cases they're not. And the last column is, and it didn't show up in terms of the title, but the last column is the multiple that was paid based on adjusted net income. Okay. The first column is the revenue of the firm. The second column is what it sold for. The third column is what the net income was, and the fourth column is just the multiple that you look at. So if somebody was making 400, it sold for 599. That was a New York City firm. These are the dates. 1021. There was a Tennessee firm that's 1.7. And I want to show you this because numbers really don't lie when people are looking at it. I can't tell you how these numbers were paid out, but when we say when we look at it and you look at the relationship even of the gross revenue versus the amount it was sold for, you can see here 921, 987, $1,500,275,000. It depends on what the practice was, but here's, like, for instance, in 2018, there's a corporate law firm that only sold for 0.70 of what their net income was. And if you look at the ones that are for sale, the interesting part is you notice the multiples are significantly higher here, because the asking price is always so much higher that the actual enterprise value that people get is typically, I would say if you look at an average here, it's probably 2 times what your net income is. That's pretty much where these transactions. I picked smaller transactions purposely because, Karen, you mentioned that we're not dealing with people with mega law firms, right? So we're talking about ones here that 1.4, 1.25. Small revenues, $735,000 in revenue, $850,000, and these are ones that are for sale. So here's one that's 1.442 that they said their net income is 502. Now, I didn't audit these. I don't know if they're true or not, but I think
and the multiple is of what? So let's go to the top line
of net income. So the 400.
So a company. Wait. So a company that had 1.4 million of gross revenues,
right,
sold for almost 600 grand. When
right,
what? The top
net income, the adjusted
net
income was 400,000.
Adjusted net income. Okay.
So the 1.5 is 1.5 times the 400,000.
Gotcha.
Okay, so that these are from a website we use called Biz Buy Sell, which is used for typically kind of Main Street smaller companies, but some larger companies as well. And these are self-reported by the folks who did the transaction, and I think they're fairly reliable in terms of what it is. And the one thing you'll notice is they are a bit all over the map, right? And that's that. So you go from 0.68 to 2.66, And a lot of it, we find that the folks in the estate planning world seem to have the most viability. They seem to have the most demand. I think it's because of, a lot of estate administration that's done. So it's ongoing revenue. Remember, one of the things that most businesses have that people want is they want ongoing revenue. They want recurring revenue in some way, shape, or form. And a lot of the folks in the estate world tend to have that, I guess, because they have, estates that they are continuing to work with, and they have some legacy business there. If you're purely transactional, sometimes it's not as good. It depends on what your work in progress is, as well as what your reputation is. But we say, look, if you've been in business for 20 years and you've gotten some great referral sources, and you've consistently done X number of dollars and made X number of dollars, even if you don't have recurring clients, there's certainly tremendous value, And Barry, I'm going to give you kind of the last word. I just, maybe you can wrap up.
Well, I just wanted to bring up a couple of points. One, if you're going to go through due diligence, you might want to hire somebody on the outside to help you with this, because the staff that you have is not going to have enough time to do the due diligence for this. I've been through some due diligence operations, and it takes a lot of time to get the information back and forth to the firms that are thinking about purchasing each other. The other thing I wanted to say is things are going to be off the wall for valuation. One thing I mentioned to Anthony before the seminar was I worked for a larger firm that happened to collect art. They would buy art from up and coming artists every single year. I think they did it twice a year. And the firms, there are some firms out there that the art is worth more than the value of their law firm, because this particular firm had Mapplethorpes hanging up in their halls. So people tend to forget about the assets that you have around your office. And in some cases, they're extremely significant. So those are just two things I wanted to throw in.
So if we wanted to contact you, do you have a slide with all your contact information on it?
We do in the beginning. I think it's the first.
Okay, so go back to the beginning. So while I have everyone's attention, again, the code is 968X. And I hope you're going to join us next month on December 9th, when Sam Millay discusses how to delegate 95% of your tasks to a virtual assistant. And I hope you're going to join us at 5 o'clock tonight for the Tax Law Committee. We're going to be discussing exactly these issues. We have Kyle Griffiths, as we mentioned, Ken Pichel, and we have Christine Malafi, who's a corporate attorney. And they're going to be discussing all of these exact things, what to look for in your agreement, how to structure the agreement, the tax considerations, etc. It looks like we have one question. What was the name of the valuation website you mentioned?
That was, well, it's actually a business for sale website. It's called Biz Buy Sell. And you can search it. BIZBUYSELL.
And is it open to everyone to look at?
Yeah, you can take a look there, and it'll have a listing of all different sorts of types of businesses for sale, mostly smaller businesses, okay? I would say most of them are under $2 million in revenue, and it's throughout the country. So you can sort by state, you can sort by revenue, you can sort all sorts of things, and you'll be able to see, a lot of some of the details that were indicated for some of the ones that I put on, and anything you want to search for. So if you're looking to buy a firm, it may be a good place to look as well.
So go back to the beginning, the first slide, because none of this has your contact information. Why don't you say out loud? Oh, okay.
God, we don't have our contact information.
Oh, okay.
Shame on us.
So why don't you say out loud your phone numbers and your emails, one at a time.
Go ahead, Barry.
Sure. Barry Jackson, 973-873-8488. And my email is bjackson@impactlegalresources.com.
And I'm Anthony Citrolo, 516-346-5272. Anthony@thenybbgroup.com. And we're located right here in Melville. So if anybody needs to get in touch with us, we're findable on the web as well.
And I thank you so much. This was wonderful. I love that last chart about the valuations across the country. Just to see what's really happening is amazing. So I thank you.
And transactions are happening. Karen, thanks for the opportunity. I really appreciate it as well.
Thank
Yeah,
you.
And this recording is available for anyone who wasn't here. You can get it right from the Suffolk Academy of Law. So thank you again, everybody. And I'm Karen Tenenbaum, Tenenbaum Law. If you need any tax help, you can contact me at 631-465-5000. And you can email me either at ktenenbaum@litaxattorney.com or taxhelpline@litaxattorney.com. And so again, we'll see you next month. And thank you for this. Guys, you were great. Thank you.
Thank you.
Thank
Take
you.
care, Karen. Have a great day.
Bye-bye.
Bye-bye.